Hi Rabbits, Research Turtle here. Today, we are diving deep into the massive economic upheaval of 2025 and 2026. We're calling it the headlines, hundreds of billions of dollars pouring into the U.S. manufacturing sector. But is this real? And more importantly, does it make any financial sense? Let's break down the anatomy of this geopolitical premium. First, we need to understand why this is happening. It wasn't a market-driven choice, it was a binary choice forced by policy. In April 2025, the equation changed. The U.S. administration invoked the IEEPA, the International Emergency Economic Powers Act, declaring trade deficits a national emergency. The weapon of choice? Reciprocal tariffs. The ultimatum given to surplus nations like Taiwan and South Korea was simple: relocate your production to American soil or face tariffs ranging from 20% to 100%. The price of peace was set at approximately $500 billion in committed foreign direct investment. By January 2026, Taiwan agreed to a $250 billion credit package. South Korea's Hyundai and Samsung followed suit. In exchange, tariffs were capped at 15%. This wasn't about profit maximization anymore, it was the cost of survival. Now, a lot of you have asked, do these countries actually have the money to pull this off? The answer is yes, but the methods are sophisticated. Let's look at TSMC. They are building fortresses with cash, not just debt. In 2025, TSMC revenue hit $122 billion with massive operating cash flow. They are funding their Arizona expansion largely through free cash flow generated by the AI boom. But there's a backstop. The Taiwan government is providing a $250 billion credit guarantee backed by their massive foreign exchange reserves. It is a sovereign corporate hybrid defense. Then there's South Korea. Hyundai isn't just shipping cash from Seoul to Georgia. They're using a revenue reinvestment model. They sell 1.5 million cars in the U.S., and instead of repatriating those profits, they plow them directly into American construction. They're also leveraging green bonds and global project financing to bridge the gap. And we can't forget Project Stargate, the $500 billion AI infrastructure plan. This isn't one company's money. It's a mix of Middle Eastern liquidity from the UAE, structured by SoftBank with revenue guarantees from U.S. tech giants like Microsoft and OpenAI. So they have the money, but is building in the U.S. actually feasible? Here is where the reality bites. We call it the America premium. Data shows that building a fab in the U.S. costs roughly double what it costs in Taiwan. We're talking about an index of 2.0x. Look at Samsung's plant in Taylor, Texas. The budget ballooned from $17 billion to over $25 billion. That extra $8 billion? That didn't buy better chips. That was the cost of inflation, labor shortages, and regulatory friction. Speed is another killer. In Asia, groundbreaking to tool in takes 19 months. In the US, it's dragging out to 38 months or more. And then there are the regulatory contradictions. In a strictly ironic twist, while the White House demanded build here, Immigration Customs Enforcement raided the Hyundai Meta plant site, arresting nearly 500 workers. Many were specialized engineers needed to install the equipment because U.S. talent simply didn't exist. This leads us to the final, critical question. If it's twice as expensive and twice as slow, is this investment rational? Surprisingly, yes, but you have to change how you calculate ROI. It's not return on investment, it's return on integrity and access. Think about the math. If a Taiwanese company exports chips to the U.S. and gets hit with a 30% tariff, they lose billions in margin instantly. If they manufacture in the U.S., their production costs might go up 10 to 20%. The inefficiency of U.S. manufacturing is actually cheaper than the cost of the tariff wall. Furthermore, there's the safe harbor strategy. By Americanizing their supply chain, companies like TSMC and Samsung gain exemptions from export controls and entity list risks. They're buying immunity. And finally, there's the trusted foundry status. The U.S. Department of Defense doesn't care about price, they care about security. By manufacturing on U.S. soil, these companies unlock a price-inelastic market that subsidizes their commercial inefficiencies. In conclusion, Rabbits, this capital shift isn't about economic efficiency. It's an insurance premium paid to maintain access to the world's largest market and the U.S. security umbrella. It's messy, it's expensive, but for these nations, it's the only path forward. That's it for today. Turtle out.